as we're speaking right now, gold and silver are both way up, and silver is outpacing gold, which is normally how the late stages of precious metals bull markets go. You begin with gold because that's the big name in the sector. When you're nervous about what currencies are going to do, you buy that gold, the gold goes up, and then you realize that for the 1 ounce of gold, you can get a whole pile of silver, and your aesthetic sense takes over. You want that big pile of really gorgeous coins. And so people start buying silver, and that being a very thinly traded market starts to go straight up. That's where we are now. Gold and silver are probably good protection from currency crises for a long way to go from here. This isn't a time to be cashing out. This is still maybe a time to be adding cautiously to precious metals positions because, we could see some really outrageous numbers, certainly in gold and definitely in silver in the not too distant future. And you want to be there for that. You don't want to miss the big parabolic move at the end.
The surge in precious metals continues to accelerate as both gold and silver push sharply higher, with silver now outperforming in a pattern historically associated with the later stages of a significant bull cycle. The shift reflects deepening concern over global currency stability, soaring sovereign debt burdens, and the rapid erosion of purchasing power across developed economies. As capital exits weakening fiat systems, investors are turning to tangible value, pushing silver's thin market structure into more explosive territory. John Rubino, a longtime macro analyst and monetary historian, outlines how this phase resembles past cycles, but with far more extreme conditions beneath the surface. With government debt costs now surpassing defense spending and inflation pressures entrenched, the current environment signals the accelerating breakdown of the long-running fiat experiment. Silver's rapid ascent, gold's renewed strength, and expanding interest in miners suggest the start of a broader, more aggressive repricing. As structural imbalances widen, the path forward points to higher metals valuations, stronger mining sector flows, and the potential for parabolic moves that have historically defined end-phase currency crises. Now, we present the clips from John Rubino's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, the gold and silver story was always, for the past 20 to 30 years, been that the big countries of the world, now that they're doing fiat currency experiments where their currencies aren't backed by anything, right, and they have unlimited credit cards effectively to borrow and spend as much money as they want to, they're abusing that power and taking on way too much debt, creating way too much currency to finance that debt, and that would eventually lead to inflation, which is to say a disorderly decline in the value of the big fiat currencies. And we're finally there. This morning, as we're speaking right now, gold and silver are both way up, and silver is outpacing gold, which is normally how the late stages of precious metals bull markets go. You begin with gold because that's the big name in the sector. When you're nervous about what currencies are going to do, you buy that gold, the gold goes up, and then you realize that for the 1 ounce of gold, you can get a whole pile of silver, and your aesthetic sense takes over. You want that big pile of really gorgeous coins. And so people start buying silver, and that being a very thinly traded market starts to go straight up. That's where we are now. So the question is, is this a gold and silver run like the previous two in, 2000, in 1999 and in 2007, 2008. Anyhow, the past two long precious metals runs we've had gold and silver topping out. Well, gold not quite at this level in real terms, and silver at $50 an ounce or so. So the question is now, is this move like those moves, or is this one a very different animal because this is the end of the fiat currency experiment? And I would argue that, the latter probably, that we're towards the end of the experiment now because governments are just awash in debt. The interest on their debt is soaring. The US pays more in interest now on its debt than it pays for defense.
Mhm.
You can't manage something like that for very long. So we're in the death spiral part of the process. And that means gold and silver are probably good protection from currency crises for a long way to go from here. This isn't a time to be cashing out. This is still maybe a time to be adding cautiously to precious metals positions because we could see some really outrageous numbers, certainly in gold and definitely in silver in the not too distant future. And you want to be there for that. You don't want to miss the big parabolic move at the end. Precious metals, which is really the basis of a wisely structured financial life right now. You get physical first. You get some
Right.
gold and silver coins, you store them in a safe place. And when you've got enough of them, then you start looking at ways to branch out into equities um, to increase your exposure to precious metals. And starting with that, there are physical ETFs, which are basically stocks of companies that just get a bunch of gold and silver or whatever, put it in a vault, and then you invest in them, and they hold that gold and silver in a safe place for you.
Mhm.
That's not 100% safe. There's still counterparty risk because you have to trust them to have in their vaults what they say they have, but they're relatively safe when they're well run. From there, you go to the big ETFs. Those are investment companies that buy the stocks of the gold and silver miners. And they take care of the portfolio construction for you. They just go out and buy the representative stocks. And so you get some of those. And then you've got exposure to mining equities from there. And then as you dig a little deeper into it, you start making your own decisions about which mining stocks you want to own. And from there, you start with the big guys that are easy to analyze because they're just, Newmont is the biggest gold miner in the world. And all the analysts are looking at Newmont. And so you got to figure it's reasonably well covered. It's reasonably, it's priced close to its value and everything. And as you gain an understanding of things like mining stocks, you work your way down. There are junior miners that produce gold and silver, but not enough to be considered senior miners. But they're also they're not as widely followed. They're a lot more volatile. So if you choose wisely, they'll go way up for you compared to the other ones. And then from there, you get down into the explorers and the companies that don't actually have mines yet, but they're digging out there. They're looking for new deposits. And that's where you find your 10 baggers in the mining space. The little guys who nobody really knows much about, but are still putting out pretty good drill results. So you
Mhm.
analyze those drill results, look at other things like how experienced management is, whether they've done this before, what jurisdiction the
Yeah.
potential mine is. Is it in a place where you consider it to be, well respected and treated by the local government? And you make a choice. And I mean, over the past 10 or 15 years, there have been a bunch of companies that fit those criteria in the explorer space, and they've gone up 5, 10, 20 times from when they were little and unknown, and so you want a few of those because that's life-changing money. If
Mhm.
something goes up 20 times, you only need a couple of those to have made a successful life as an investor. And those are the things, and you got to be careful with those because they're addictive. Once you had something go up 20 times, you want that feeling again.
Yeah.
And that you did it once, you're a little cocky. So you're addicted to the feeling and you're kind of cocky about your abilities. And then you can go out and buy 10 more of those things and all of them will go bankrupt or something like
Yeah.
that. So you need to be very careful to not think you're a genius when you win a couple of times in that space. But anyhow, you do that, gradually work your way into the mining space. And once you have enough understanding, then it becomes a really fun game to play because especially in times like this, where the last couple of years, the gold and silver miners have been the best performing
Mhm.
financial sector in the world, better than cryptos, better than AI stocks. You wanted gold and silver miners. And so once something like that happens, it gives them legitimacy.
Mhm.
And so now the next run is starting with them because Wall Street is catching on. They've got these momentum charts out there where they're on their screens. Gold miners are suddenly popping up for the first time ever. So the momentum money is starting to chase precious metals miners. which gives them that last big parabolic leg out there at some point. So now is still, despite those stocks having done really well for a while, it's still a good time to be buying them wisely. Don't just jump with both feet into whatever has gold or silver in its name, but buy quality. And you still have a good chance of making lots of money in the next few years in those things. Or think back to the 1970s. We've already had a version of this, only a really mild version. But, we had spiking inflation back then. And life got much harder for people. Energy got super expensive. Food got expensive. And we thought for a little while that the dollar was dying at the time. So this is a much more serious version of that because the numbers are all way bigger and everybody's much more deeply in debt. But the people who least deserve to be hurt by this are the ones who get hurt, like regular consumers who trust the government, for instance, who own a lot of cash and have government bonds in their investment savings portfolios, and who are trying to get by day to day. They're working at their jobs, they're trying to pay for their food and gas and things like that. Well, those things are going to go way up. Life is going to get much harder for you if you're sitting on a pile of dollars, which go down in value, while the things you need to spend those dollars on go up in value. And that's just the way those things work. And then, of course, you get political chaos when that happens, because if people are being just bled dry by an economy that the government engineered, then who wants that government in power anymore? So the peasants will pick up their pitchforks, head to the castle, and pull the aristocracy out. Hopefully, only in a financial way, but maybe in a physical way too. You just don't know. So we get kind of a French Revolution scenario going. I think there's a good chance 2026 is a wild year because there's so much that could happen. Like in the scenario I sketched out, where we drop into recession and then all hell breaks loose. Very possible. And then you've got geopolitics and politics in the U.S., Europe, and possibly China, possibly Russia. There's just an awful lot of things going on out there where, we're right now, the U.S., we're picking a fight with Venezuela. We'll see how that goes, but there's no real way to know. And we're not out of the woods yet with Ukraine. So there's an awful lot of geopolitical stuff that could happen on top of, and then the U.S., of course, has a midterm election that's leading the U.S. government to do a lot of panicky kinds of things right now. I mean,
Right.
50-year mortgages, $2,000 stimmy checks for everybody. That's the kind of stuff you do when you've got an election coming up and you don't care what happens in the future because you've got to win that election. And there's a really good chance that can be misinterpreted or actually correctly interpreted, where people don't react to it the way the government wants, but they react to it correctly as signs that the government is panicking, and that just exacerbates everything. So 2026 could be wild, but for the people who are already loaded up on commodities, it could be a life-changing year. So we'll just have to see. I mean, I think for a lot of people, it'll be life-changing in a bad way. A handful of people, it'll be life-changing in a very good way. I think there's a decent chance this coming year is life-changing for just a broad spectrum of people in the developed world.
A broad global currency breakdown is unfolding as major economies push their fiat systems beyond the limits of sustainability. Decades of unchecked borrowing, rising deficits, and continual monetary debasement have simultaneously eroded confidence across all advanced nations. Inflation has already pushed living costs dramatically higher, and even a return to moderate rates cannot undo the structural damage. With households drowning in credit card interest rates near 25%, student loan delinquencies rising, and subprime auto defaults accelerating, consumers are being squeezed from every direction. The pressure now feeds into recessionary dynamics, falling disposable income, slowing consumption, weakening corporate earnings, and the growing likelihood of an equity downturn severe enough to force new rounds of emergency intervention. Such interventions would further widen deficits, undermine trust in government bonds, and accelerate the decline of major currencies. As confidence erodes, capital rushes toward tangible assets, such as farmland, energy, and precious metals, as the purchasing power of fiat erodes. Let's get back to the interview.
governments have screwed up their currencies since we've had currencies.
Right.
A government will start borrowing too much money and then debasing their currency in some way, and then people lose faith in the currency. Its value collapses, and then each and every time we've gone back to gold and silver because that's humanity's original money, and it can't be debased because you have to dig precious metals out of the ground, and that's hard and getting harder to do all the time. So that limits the supply of those things. And because they're rare, they tend to hold their value going forward. And that's where people pile into when they suspect that their government is screwing up their currency. Now, what's happening now that's different is that in the past, currency crises used to be one country devaluing their currency dramatically in the context of the sound money world. Everybody else was on the gold standard. You screw up your currency, you have a crash, and then you go back to gold and silver. Well, now it's the whole world, basically, or at least all the major countries. They have fiat currencies, they're inflating them away at varying rates. And so this is going to be different in that sense, in the sense that it's a global currency crisis, because, if the dollar starts tanking, that pulls down the euro, that pulls down the Swiss franc, the British pound is going to crash no matter what. And the Chinese yuan is being inflated away really aggressively as well for their own reasons. Yeah, so all of these things are going to happen kind of simultaneously once they get going, and you can make the case that they're already happening.
Right.
That we had this burst of inflation during our response to the COVID pandemic. So the cost of living is already much higher than it was a decade ago. And so they're hoping for like 3% inflation in the US going forward and thinking that fixes things. But it doesn't actually, because most people's cost of living is already way up. So having it grow by only 3% a year is still a crisis for the average person. And, we've got a recession coming, which we can talk about the details of that in a minute. But let's say a recession happens, governments usually respond to recessions with dramatic increases in spending, which means if we're running $2 trillion a year deficits now, we'll run $3 or $4 trillion deficits in the face of the next recession. And that'll just spike interest costs, which they have to be borrowed. So that will spike next year's deficit, et cetera, as we enter a death spiral. Where the currencies just start to fall off a table. And I would say that we're basically there. We're at the beginning stage of that, and there's no way out of it. So yeah, fiat currencies are currencies that allow governments to do this, basically. In other words, they're not backed by anything, so governments are free to borrow and spend as much as they want. We started that experiment in 1971, and it's kind of come to fruition now. So the question is, what happens after? Because it's kind of guaranteed that we're having that big currency crisis. So, do we do a currency reset where we go back to a gold standard? And do we bring Bitcoin into the mix? Or do we just, run it out and have kind of a Weimar Germany hyperinflation that nobody can predict the outcome of, and hopefully we'll do the smart thing, which is a currency reset sooner rather than later. But when have the guys in charge of most of the big countries done the smart thing in our lifetimes? And the answer is almost never. So it's completely possible that we have just a horrendous currency/financial crisis in the not too distant future, and we basically just have to live through that. And right now, we should be trying to prepare ourselves for it. We're already kind of tipping into a recession because Americans and most of the rest of the world, at least the developed world, they're running out of money. Credit card debt is at all-time highs, and the interest on credit card debt is in the mid 20% range. So anybody who's carrying an ongoing balance is being just drained dry by their credit cards. And there's a growing number of people in that situation. Student loans are now having to be paid upon, and a growing number of borrowers are starting to default on their student loans because of that. Car loans, same thing. The delinquency rates on these subprime car mortgages that people have been taking out in the last decade are spiking. So basically, you're not going to see people go out and spend a lot of money in frivolous ways because they've already done that, and now they're paying a price for it. So you're hearing, companies like McDonald's, other fast food places, say, nobody's coming in for breakfast anymore. They're either eating breakfast at home or they're going to convenience stores and buying, shrink wrapped breakfast burritos at 7-Eleven or something like that, which is, it's a horrifying thought that people are having to do that. But when people can't afford fast food, that's a sign they can't afford much of anything. So expect consumer spending to trend down in the year ahead, and we're a consumer spending driven economy, so expect the economy to slow down and then drop into negative territory. That will cause an equities bear market, because equities tend to fall during recessions because corporate profits fall during recessions, and since we're wildly overvalued in equities right now, we've got a major equity bubble, and let a downturn begin in equities prices, and it's liable to just turn into an avalanche. So we'll have a huge equities bear market, maybe a crash, and then the government will have to step in and start bailing out the sectors of the economy that may be broken by an equities bear market and a recession. And then people start looking at the extra $5 trillion that the government is having to throw at all these broken sectors in the economy, and they'll start wondering if that means the currency is becoming worthless. So nobody will want to hold U.S. bonds, and that'll spike interest rates. And then boom, you get a Federal Reserve with no tools left to fix anything, financial markets who absolutely do not trust anything the government's trying to do in any event, and a currency crisis. Nobody wants to hold dollars. There's a thing called the crack-up boom in the Austrian School of Economics that I'm kind of describing here. When people, a critical mass of people, lose faith in a currency, they just start dumping it. As soon as they get paid, they buy real stuff with that currency. So you see the price of real things like farmland and gold and silver and oil and yada, yada, go through the roof, which is to say the value of the currency relative to those things just crashes. And then, that's it for the currency. People give up on it. And then something has to happen at that point. And, we'll see what that point is. But I think, the scenario I just sketched out, each of those things follow logically from the previous thing. And that takes us to, let's say 2029, something like that. And the whole system is broken. So we'll see. But that's a very plausible scenario.
Global monetary conditions are deteriorating as governments exhaust the credibility of their own currencies. Years of uncontrolled debt expansion, persistent inflation, and policy mismanagement have pushed major economies into a synchronized downward spiral. The strain is becoming visible in households as credit card balances surge, and delinquencies spread across auto loans, student loans, and consumer credit. With disposable income tightening, spending weakens, feeding directly into contractionary pressure across the broader economy. This environment sets the stage for significant financial instability. Equity markets remain heavily overvalued at a time when recession risk is intensifying, and any sharp downturn would likely trigger emergency stimulus that further accelerates the decline in fiat purchasing power. As confidence erodes, capital naturally seeks refuge in tangible assets. The trajectory points toward a period of accelerated currency stress and elevated volatility across global markets. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.